Have we got the ingredients lined up, the recipe for some bond market stability?
You know, it's funny, as we were talking about as we came on, there is such confidence here across the street that bond yields have peaked. Right? Yields are off 40 bips from the highs. I think we got to see a little bit more to say with conviction that we're done with rates up for this cycle here. I mean, the trend in yields is 3 years old. It's been pervasive. And after 10 days, we're all ready to close the book on it. I think we need to see more. At a minimum, I would say, what's the plot twist in front of us? I think the playbook of rates have peaked, therefore buy risk everywhere. It seems a little too October 2022, not October, November 2023. And is the plot twist, A, we haven't seen the top in yields, or is the plot twist we have, and it's not as bullish for risk as many people think? That, I think, is the big question as we look ahead.
Before we get there, we need to break into that and drill down on that. Okay, you said I need to see more. Do you need to see more in price or more in the data? Or just need to see more of?
I want to see price's interpretation of the data. I mean, we're sitting here, 10s are still above the 50-day moving average at, call it 450 and change. The 200-day is still upward sloping. The trends for 10-year and 30-year yields everywhere around the world are still up. You could convince me the short end is probably topping in yield here. If you look at some of the 2-year yields across Europe, I can get there. I just think it's way premature to make this call with longer dated bond yields yet.
To build, though, on what John was talking about, last week was set up with a pretty perilous type of technical behind it, where the short positions by hedge funds on U.S. government debt at the highest levels going back to 2006. Have we washed out some of that unevenness, or can we expect bouncing around by 50 basis points every couple weeks in Treasury yields?
You know, it's funny. I think there's this tension in the positioning data. A lot of the stuff we look at from, say, CFTC would suggest there's big shorts still in the long end of the curve that might need to cover here. But when you kind of reconcile that with some of the anecdotal information out there. I mean, look at the last 2 weeks. Cover of Barron's, buy bonds. Wall Street Journal, buy bonds. FT, buy bonds. There's this tension here for a bear market that's 3 years old in bonds. You would expect there to be more fear out there. And that just seems so inconsistent with how things bottom.
When we talk about the data and the response to data, is it the data of economic slowing, or is it the data of how much debt the U.S. Treasury is going to sell? Is that more important for the longer end of the U.S. Treasury curve?
Well, I think that's the secular tension. It's why we have the steepener. I like the steepener, right? So there's a couple ways we get the steepener. Either 10-year yields or 30-year yields continue to rise and 2s fall or 2s stay stable, or 2s fall faster than the long end. So I think the steepener is still in play. If you look at a chart of the unemployment rate versus the steepener, it's the same exact chart. I mean, we just went 3.5 to 3.9 on the unemployment rate in a couple months here. So I think there's a case to be made. The steeper curve here is playing very much as it tends to do late in a cycle. You tend to get economic deterioration, you tend to get a steeper curve, you tend to get a rotation in the equity market away from the pro-cyclical corners to the more defensive. What was one of the standouts last week? Utilities, right? So there's a little shift underway here that I think we want to be mindful of.